Right, moving on then. So that's that at acquisition entry that we do, and I've explained what we're trying to achieve there. Basically, bring on the assets and liabilities at fair value. Okay, create this new equity thing called NCI, and the resulting balance was either goodwill or a bargain purchase. That was the net effect, if you like, of that IFRS 3 entry. Right, now that is then going to have a knock-on effect every year after that. So what we're doing is we're saying, at acquisition, we're saying, listen, this thing's a subsidiary over which we have control. Okay, let's not account for it as a one-line item. How do we account for it as a group? Every asset, every liability, line by line. Okay, big difference between the two. Right, so what knock-on effect does that have in subsequent years? I've explained already why we differentiate between since acquisition to beginning of year and the current year. Reason being, anything profit or loss or OCI related for previous years is going to affect statement of changes in equity. Anything profit or loss or OCI related in the current year is going to affect the current year's profit or loss or OCI. Right. Good. So, since acquisition to beginning of year, first thing you consider is this. At acquisition, in that at acquisition entry, I told you that we needed to revalue the different assets and liabilities that needed to be revalued, not so. All right. And you'll appreciate that's a pro forma entry. Eh? That doesn't make the machinery bigger in S's separate financial statements. That doesn't make the land bigger in S's separate financial statements. So please understand this. When you add H plus S together at the reporting date, what values are on that trial balance? The unadjusted values. Eh? All right. And then in this entry, we adjust a whole lot of assets and liabilities. Now think about that for a second. If, for example, the asset we adjusted was machinery, you're going to have to adjust the depreciation on that machinery. Think about it. If you make the machinery bigger, okay, in the group, but you haven't made the machinery bigger in S. In S's separates, how have they worked out depreciation? Old figure, not so. So just like we did with our intercompany, I said to you, if you make your asset bigger, you must make the depreciation bigger. If you make the asset smaller, you must make the depreciation smaller. Right, so if you need to make the depreciation bigger, credit accumulated depreciation. So essentially what you're doing is you're going back to your at entry, and you're going to look down that list of assets and liabilities that you debited and credited, and ask yourself, what do we do with those assets and liabilities subsequent? If it's a depreciable asset, depreciate it. And then the other side of the entry is your depreciation expense, not so. But if it's in a prior year, it affects opening balance retained earnings. Does that have a tax effect? Yes, it does. Okay, no change in the tax rule. Eh? And then make a note to yourselves, please, that that entry could go both ways. So in your at entry, you could have made the asset bigger. A bigger asset needs more depreciation. A smaller asset needs less depreciation. I know that you know the journal entry for depreciation is debit depreciation, credit accumulated depreciation. Okay. If you need more of that, then make more of that. If you need less of that, it's the other way around. Eh? This is just giving you a couple of examples. If the asset at acquisition that you revalued was inventory, how do you use inventory? You sell it. So don't depreciate your inventory, for goodness sake. Okay? When you sell the inventory, just reverse out the inventory. Other side of the entry, cost of sales. In a prior year, retained earnings. Does that need tax? Yes, it does. Make a note to yourself, that entry could go the other way. It may be at acquisition, we credited the inventory, not so. Now when the inventory gets sold, you no longer need that credit. How do you get rid of a credit? Debit the inventory, credit cost of sales of a previous year, that's retained earnings. At acquisition, if we had valued a liability upwards, okay, what could happen in a subsequent year? that liability could be paid, let's say, or it could be settled if it's a court case, something like that. All right? And then when a liability gets settled, what do? You reverse the liability. Debit the liability, credit whatever expense it is that you debited in the separates of the subsidiary. Right? And once again, that entry could be the other way around. So it could be at acquisition you made a liability smaller. Now, when that liability gets settled, okay, whatever you did to the liability at acquisition, you no longer need. So reverse it out. Then people say, why bother? Why bother doing it? Why not just make it nil? Well, because in your at acquisition entry, the balancing figure is what? Goodwill. And you work that out based on the situation that existed at the date of acquisition. In subsequent years, check when we make those adjustments in subsequent years. What does that affect? Goodwill? No. Look at the other side of the entries there. In every single case, it is retained earnings. So if you want the marks for this, put the other side of the entry in retained earnings. Don't say, oh, it all nets out at 0. It doesn't. Okay? The at acquisition entry balances out or nets out in the goodwill number. Since acquisition, it's going to affect retained earnings. Okay. Got a question here with land. What happens? If the asset you revalued at acquisition was land, so in your at entry, you revalued your land, what did we say earlier? Upwards by 100,000. We said that would have a DT effect of 22,400. Okay, so the process I'm asking you to go through. Since acquisition, you go back to your at entry, you have a look at it, you say, did we revalue anything? Yes, we revalued land. Okay, cool. What do you need to do now? Do you depreciate land? No. Okay, so do you, if the land is still there, do you still need that adjustment? Yes, you do. So just leave it as it is. It's in your at entry, leave it as it is. Okay? If you sold the land, you could have sold the land, eh? If you've now sold the land, do you still need that adjustment to the land? Of course not. So what are you going to do? If you've now sold the land in a subsequent year, I want you to reverse that. So you're going to credit land, 100,000. Debit what? No. Debit what? Just ask yourself the question. When the sub sold the land, what entry did they put through their records? That's accounts 1. They would have gone debit bank with the money they got. They would have gone credit land. And where would the balancing figure have gone? Profit or loss on disposal. Profit on disposal. All right. Because you're my full-time group, only, I'll show you what you're doing there. You see, what happened at acquisition? If you want to understand this, okay? What happened at acquisition is the carrying amount of the land, let's say, was 900,000. At acquisition, we reckoned it was worth $1 million. So what did we do? The adjustment we put through was 100,000. That is this adjustment over here. All right? So you're happy now at group level. What is the value of the land? $1 million. What do you do with that land year on year thereafter? Nothing. It just sits there. In S's books at 900,000. In the group at $1 million. Because every year after acquisition, you still process the at entry. Not so. Every year you go, S's land is 900, put through the at entry, makes it $1 million. Now they sell it. It gets sold for 1.2 million. So the entry in S would be debit bank 1.2 million. Credit land, how much? 900,000. Giving a profit of 300,000. When you add H plus S together, okay, the 1.2 million will be in the bank of the group. When you add H plus S together, the 300,000 profit on disposal will be in the group. But at a group level, is the profit 300,000? No. The group received 1.2 million from an outsider, and they gave up land, which is in the group, at how much? 1 million. What should the profit be? 200,000. How do you get there? Do you typics out the 300,000 and make it into 200,000? You can't. You add H plus S together, not so. When you add H and S, one of the incomes in S is going to be what? 300,000. If it's in S, it finds its way into the total, not so. If it's in S, it'll find its way into the group. It's just arithmetic. But is the 300,000 correct at a group level? No, it isn't. So the entry we need to process is credit land, which now gets rid of that, and debit the profit. The profit, which is 300. Put through your entries. If you debit the profit, you make it smaller by 100 and end up with 200, which is correct at group level. Okay. Has that answered your question? It better have, because I can't explain it any differently. Okay, but the principle is this. In the period since acquisition to beginning of year, go back, look at your at entry. Okay, and go and check there. Check every asset and liability that you remeasured. Check every debit and credit in your at entry to every asset and liability, and ask yourself, what have I got to do with that now? PPE, depreciate. Inventory, sell it. Liabilities, maybe you paid, maybe you didn't. What if you hadn't paid the liability? Then just leave it. Maybe next year you pay it. But when you pay the liability, what must you do? You must reverse that adjustment you made at acquisition. All right. So we look at our IFRS 3 remeasurements, those IFRS 3 adjustments, and we consider what to do with them in the period subsequent to acquisition up until beginning of year. Next, in our at acquisition entry, to be perfectly frank, we created this new concept called NCI, not so. And at acquisition, that NCI was measured, we said two possible ways. We said at equity value or at fair value. Right. You have that choice at acquisition. Subsequent to acquisition, okay, you need to adjust your NCI. Okay, but here there's no choice. It has to be at equity value. All right. So for NCI, we've got our at acquisition figure. Agreed? Right. Now what you need to do is you need to make that NCI figure bigger or smaller by the increase or decrease in equity value. Okay, so think about what we've got to do. Two ways, I suppose you can do it. You all know assets minus liabilities equals owner's equity. All right. So what you could do is you could check what the NAV, what the net assets and liabilities went up by. And whatever they've gone up by, give NCI a share. Because at any point in time, what should NCI have in their NCI column? Their share of the assets and liabilities. But our job is assets minus liabilities equals owner's equity. And we've been told that in this consolidations thing, this is not just going to be the old way of doing it. This has got to be split between the parent and NCI. Anything NCI related that is in owner's equity needs to be in a separate column called NCI. So check to see if the equity's gone up. If it has gone up, give NCI a share. If it goes down, give NCI a share of the increase or the decrease as the case may be. All right. The way you're actually going to do it is, you see, you're going to have the trial balance, aren't you, at the beginning of the year. So you're actually just going to cut to the chase. You're going to go to your owner's equity accounts. You've got retained earnings. You've got mark-to-market reserve. You might have an actual reserve for defined benefit plans. You might have a reval surplus for PP&E. Come, give me some other owner's equity accounts. Geez, for those of you listening at home, let me tell you, I'm being faced with stunned silence over here. I need 3 more owner's equity accounts. For each one of those owner's equity accounts, you check to see, has it gone up or down since acquisition? And give NCI their share. Okay. So what I'm getting at over here is, let's say at acquisition, and bear in mind, at acquisition, just have a look here again. There's the retained earnings at acquisition. You've always got to find out what that is. You never have a choice in the matter. Now go to your trial balance and look at the retained earnings at the beginning of the year. Let's say that was 50 grand, and that was 75 grand. Retained earnings has gone up. Tell me you can see that, please. All right. By how much? 25,000. And tell me, where is that increase in retained earnings? Go back to your basic consolidation procedure, which is H plus S, not so. You tell me, where's that increase in retained earnings? I'll tell you, it's in retained earnings. It's in the group's retained earnings. And is it all ours? No. What are you going to do? Give NCI a share. Let's say they own 40%, for argument's sake. Give them 40%. So there's your calculation. That's 10 grand. And we need to take away from us and give to them. Okay. So you need to take away from the parent's retained earnings. Debit retained earnings makes your retained earnings smaller. And give to NCI. How do you make their owner's equity bigger? Again, please, you should all know that owner's equity is typically a credit balance, not so. You make it bigger on the credit side, you make it smaller on the debit side. Make a note to yourself. That could be the other way. Give NCI their share of the increase or decrease, not just in retained earnings, in any reserve that you might have. I've written down 3 there, the 3 most popular ones. The mark-to-market reserve that you get with financial instruments, revaluation surplus, which you get with PP&E. All right. But there are any number of OCI items which ultimately get their own reserve. And for any of those that go up or down, give NCI their share. Got it? Not quite that simple, I'm afraid, because that you got off the trial balance at acquisition, eh? That you got off the trial balance at the beginning of the year. And if you look very carefully, in the same period since acquisition to beginning of year, we made a number of adjustments to retained earnings, didn't we? And at group level, those things make the retained earnings bigger or smaller, not so. A debit to retained earnings, smaller. A credit to retained earnings, bigger. So what we're doing in essence is, what we've got to do then is, for all of those adjustments, plus or minus those, IFRS 3 subsequent measurements. That's why I go in the order that I go. That's why I do them first, because they have an impact on retained earnings. All right. So it's 25,000. You'll get a mark for that. Seriously, you'll get 1 mark for that, which you would have got in second year. A half times a half. Then you depreciated the asset that you revalued. You get another half. With its tax, another half. Then you paid the liability, another half. And its tax, another half. Okay, so in all, the entries out of half, half, that's 1, 2, 3, 4. All right. And maybe you get 1 out of 4. That would be terrible. Everyone's got to get 2 out of 4. Like you work out, my retained earnings went up. Give them their share. You get 2 out of 4. Then you do the depreciation. You get 3 out of 4. And you do the tax. You get 4 out of 4. Whatever the case may be. You get the picture. If you go back even further, here's my intercompanies I did earlier. Let's just do that one over there. Doesn't matter which ones, like there are lots. And there are going to be lots more to come. Okay? Look at those entries carefully. Can you see any adjustments to retained earnings in those figures? No, the truth is, anytime there was a profit or loss adjustment from a previous year, what did we do? We debited or credited retained earnings, not so. A debit makes retained earnings smaller. A credit makes it bigger. So let me ask you this. Should we, if there's a debit to retained earnings here, should we make an adjustment to the NCI share of retained earnings in your period since acquisition to beginning of year? Yes or no? I'll give you 3 choices. Yes, no, depends. Hands up for yes. Hands up high. Everyone's got to vote. Kick you out if you don't vote. So in ascertaining whether you're going to give NCI their share of this adjustment, ask yourself one question. Go back to the original transaction. Remember I said to you earlier, it doesn't matter who sells to who. H sells to S, S sells to H, or P sells to S. Okay, it doesn't make any difference. The entry stays the same. All right. But if S made the profit on the original transaction, if S made the profit, okay, that's why on any of the undergrad videos with Ralyn, she'll be screaming at the top of her voice, who made the profit? Okay, because if S made the profit, you need this entry. If P made the profit, you need this entry, stays exactly the same. But if S made the profit, you need this entry, and you need an adjustment to that entry. Plus or minus the effect of your intercompanies. More specifically, plus or minus the effect your intercompany had on retained earnings for the first one, mark to market for the second one, reval surplus for the third one. They were all retained earnings, weren't they? Okay. Plus or minus the effect that your intercompanies had on retained earnings. But please, only for those intercompanies where S made the profit. So the intercompany is the same, eh? Doesn't matter who makes the profit, P or S. But if S made the profit, then that debit or credit to retained earning has a compounding effect, or has an effect on the amount of that retained earnings that we give to NCI. Okay. Right. And then the third thing that we created in that at acquisition entry, which is something new, was either the goodwill or that bargain purchase, not so. It was that balancing figure. If you've got goodwill, which is an asset, that goodwill needs to be tested for impairment every year. All right. Just out of interest, in terms of IAS 36, which we do in the IFRS paper, I will teach you how to test goodwill for impairment. In this group's paper, they're not going to cross the 2 over. So they will tell you or give you the means to work out whether or not goodwill needs to be impaired. If it's a yes, you've got to write your goodwill down. Right. Just take very careful note of the credit. It is not goodwill. Right. It's accumulated impairment of goodwill. So you all know what accumulated depreciation is, eh? It's the systematic depreciation of an asset. So we show the asset at its gross amount less its accumulated depreciation, not so. And that gives you the carrying amount. The only difference between accumulated depreciation and accumulated impairment is the one is a systematic write-down and the other one is less systematic. All right. So what I'm asking you to do over here is goodwill, just like PP&E, it's an asset and it's disclosed at cost or at its gross amount less accumulated impairment. All right. So strictly speaking, you can be penalized if you call that goodwill. Okay. Because the account is accumulated impairment. Like if I say to you depreciate an asset, you're not going to go debit depreciation, credit the asset. Please say you're not going to do that. Okay? You're going to go debit depreciation, credit accumulated depreciation. Goodwill, debit. The impairment loss, which in the prior year is retained earnings, and credit accumulated impairment of goodwill. All right. Does that have tax? Based on what I've taught you up until now, your answer should be yes, it has tax, because the entry is SCE and SFP. All right. Goodwill is exempt from all tax. So no tax, but that's peculiar to goodwill. Are we clear? And then you can see that the entry there's a debit to retained earnings, not so. So the obvious other question is, should that affect the NCI share of retained earnings? For all the other IFRS 3 stuff I did, when I depreciated the asset, it affected NCI. If it was unrealized profit and S made the profit, it affected NCI. Okay. Here, there's an adjustment to retained earnings. Should it affect NCI? Let's try the voting again. Yes, no, or depends? Depends. On what? Depends on whether NCI at acquisition were at fair value or at equity value. So if I go all the way back to my at acquisition entry, all right. Remember we had the choice, NCI at fair value or NCI at equity value. And I said to you, NCI at fair value was, in just about every circumstance, likely to be bigger, which then results in the balancing figure for goodwill being bigger. And the theoretical thinking behind that is, if NCI are at fair value, that includes their share of the goodwill. Therefore, the goodwill figure is bigger because it includes their share of the goodwill. If you measure NCI at equity value, look very carefully. I worked out the equity value. I said debits minus credits multiplied by their percentage. Eh? But in those debits and credits, there's no goodwill. Not yet. So can you see where NCI are at equity value, they very, very specifically exclude their share of goodwill. Right. So just another way to word that, I've written down for you over here. Right. So your balancing figure for goodwill is either full goodwill, which as the name implies, it's everything, including NCI, proportionate, just our proportion. That is to say, excluding NCI. Right, so if we are on the full goodwill method, the goodwill includes NCI share. It stands to reason then they should get a share of the impairment. If NCI are at proportionate share, the goodwill excludes anything NCI. It stands to reason they should not get a share of the impairment. Okay, and that's why I do this entry completely separately. You're welcome to include it in other calculation. It's just that they don't always get there. Okay. All right. So you do that entry, give NCI a share of that loss if you're on the full goodwill method, not if we're on the proportionate method. And then my last entry over here, which is not necessary. UNISA will never show this entry. Right? I do it for very good reason. So you'll notice across the board, everything I've done, I've gone back to acquisition. I said, did we revalue any assets? Okay, now depreciate them. We created this new thing called NCI. Now, make them bigger or smaller. Right? We created this thing called goodwill, test for impairment. Or we had this discount. What do you do with the discount? And the discount you need to realize. I said to you, where do you put it? You put it into profit or loss immediately. All right. Well, profit or loss on the acquisition date. And if that happened 5 years ago, where must that profit go? That must go to retained earnings. I have no problem if you write in your at entry retained earnings. That's fine by me. All right. But I marked for UNISA for close on 20 years. All right. And one of the things I can tell you is that students left that figure out of their opening retained earnings with monotonous regularity. So they would calculate it. They would do their at entry. and they'd calculate that there was a bargain purchase. And then they would forget to put that bargain purchase in retained earnings when they were doing a statement of changes in equity. And how many marks do you think they would lose? You ask yourself, showing that in retained earnings, what do you reckon it's worth? So how do you get that figure? You're going to say, that's the balancing figure from S1. So let's go to S1. So you're going to become world champions at referencing. UNISA, do not mark your workings unless they are properly referenced. So in S1, let's check this out quickly. It's the balancing figure we said. Balancing figure of that entry. What's going to be in that entry? Let me tell you what's going to be there. You're going to have share capital, definitely. Retained earnings, definitely. You're going to have at least one or maybe two other reserves, half-half. I said to you, the likelihood is you're going to remeasure how many assets. I said 2 or 3. Let's go hardcore, 3, half, half, half. Assuming they don't even need calculations. And each one of those has a tax effect, half, half, half. We remeasure 2 liabilities, half, half. Both have a tax effect. NCI is half, half. It's either their percentage of assets minus liabilities, or number of shares times share price. The investment, if they give it to you, is a half. All right. Once we've done IFRS 3, you can see that can be worth multiple marks as well. All right. And the question says, give a statement of changes in equity. So then, if the question gives me a statement of equity, where are all those marks going to be awarded? The effect of all of that is the bargain purchase. That was the balancing figure. What do you got? 1, 2, 3, 4, 5, 6, 7 and a half, 8 and a half, 8 and a half marks. You can show that figure. That number can be correct in your journal or your analysis of equity. 100% correct. How many marks do you get for your correct figure in your working? And the answer is nothing, not a single mark. Okay. The way I mark as a marker is I will go to, so my required was prepare the statement of changes in equity. So you'll have name of the company, statement of changes in equity for the year ended. And you'll have a share capital column, a retained earnings column, and a whole lot of other columns, and an NCI column. Happy days? Okay. And here you'll have opening balance. Okay. Or balance at, and you'll have the first day of the year. And you will have a figure there. And in consolidations, how do you work out that figure? The same as you work out any other figure in consolidations. It's going to be little 1, little 1. Don't put the little 1, okay? And you get the figure correct, you get full marks. Right. It's never happened. In history, it's never happened that a student has got the opening retained earnings correct. Right. If that's freaking you out, go and get some therapy and sort that out now, because you're not going to get the number right. But what you will get right is H plus S. You don't write an H and an S, okay? You're going to write H's opening retained earnings plus S's opening retained earnings. Then you've got minus in that at entry. Remember there was a debit, okay? Then in your intercompanies, there were a whole lot of debits and credits. Are you happy? Then in your since to beginning of year, IFRS 3 stuff, there were a whole lot of debits and credits. And then plus that bargain purchase. Now, if you put it in, that's fine. But I don't know why. I don't know why students don't, when they don't see it, they don't put it in. But I know time and time again, students would show this calculation. They'd get a lot of it right. But the one thing they left out just about all the time was the bargain purchase, if there was one. And if you leave it out, okay, so mine would be, the bargain purchase, and what entry is it of mine? It would be S13, so I would have that, the number, and I write S13 like that, and then I want to get I might not get 8.5. So S13, I tell the guy, go look at journal 1. He goes and looks at journal 1, the share capital, and I get 6 out of 8.5. All right. But you leave it out, then I know the answer to that question. Okay. If you leave it out, you get 0. And that's the only reason why I've built this in as part of the procedure. Okay. I've built it in so you don't leave it out. And it's a high risk item if you leave it out. It comes up here, and the other time you get that is in cash flows. Okay. When you do consolidated cash flows, can you guys remember cash flows vaguely from second year? Maybe not. Okay, vaguely. Did you know you got to make adjustments for non-cash items? Okay, that's a non-cash item. Do you know what the record for that one is? Okay, so you're working out cash paid to suppliers and employees, and you've got this non-cash item that you've got to adjust for. Okay, the record for that one non-cash item, the working was worth 13 marks. I kid you not. And you know how you worked out that amount? You did your at entry, or did the at part of your analysis? Oh, there's a discount. Where's that? In profit or loss. And these oaks had offset that profit or loss against other expenses. So it was a non-cash item. If you put it in, you'd have got 5, 6, 7, 8, 9, 10, 11, 12, maybe even 13 out of 13. If you left it out, guess what you got? Yeah. Even if you did the calculation, if you leave it out of your answer, you will get 0.